slide. Okay, back to the chart of accounts. Some tips here when you are considering updating this. And again, I've talked a little bit about taking a look at the IRS Schedule F. Because eventually somebody's going to have to combine from your list of your chart of accounts or separate if you've really got a short list of on your chart of accounts to fit into this Schedule F for tax reporting. But don't just use that. Break that down, set up subcategories or classes so that the information is detailed enough for your needs. Let's go to the next slide. Okay, back to a little bit of a definition, and I know that you've seen some of this before, so I'm not going to spend much time on it. But variable costs are costs that change proportionately to sales. So in order to sell more of product A, you're going to have more variable costs. So if you go back to thinking about the number of lambs you're going to raise and sell, we can look at that feed as being a variable cost. The more lambs you have, the more feed you're going to need. So these are expenses incurred directly in sales, example, seed, fertilizer, raw materials, inventory, direct labor. And some of you might be looking at service enterprises. I think I saw that somebody was thinking about buying a piece of equipment and then doing contract harvesting, and that would be under a service category. And typically with those, you don't have a cost of goods sold because you're not producing or selling a product. All of those expenses associated with that contract harvesting would be under an indirect cost, and so you would need a class or something like that in order to track it separately. Next slide. Okay, so each enterprise, in my opinion, should have a separate cost of goods sold. And so the way, even though this might not be technically correct, if you have livestock, if you have crops, if you are doing contract harvesting, the way I would set it up myself and the way I recommend other people do it is to have a cost of goods sold for each enterprise. And then when you post your receipts, when you either posting them into that expanded checkbook, posting them in Excel, or possibly posting them into QuickBooks or an accounting program, you're going to need to break it down. So if you are wanting to keep track of your chickens versus your cows, and you're buying feed in bulk, let's say you're buying corn, and some of it goes to the chickens and some of it goes to the cows, you're going to need to know what percentage is going to which and make that allocation when you post that purchase of the corn or fertilizer or other direct expenses. Separate it by enterprise if possible. Next slide. So in addition to those costs of goods sold, which are variable costs, which are direct costs, you're going to have some fixed costs, which some people might call overhead or indirect costs. They're called fixed because they remain the same regardless of sales level. And not everything is exact, so some of these might go one way or the other. So typical examples of fixed expenses are going to be advertising, rent, interest, insurance, utilities, accounting, and manager's labor. Given a long enough period of time, as pointed out in the book, everything becomes a variable cost. even your rent. So if you are debating on renting that land from Mr. B this coming year, it is varying. It has become a variable cost because it is not something you have already committed to. I hope that makes sense. So on the next slide, I've got some examples, some more examples of things that could be fixed or variable depending on how detailed you want to get and are able to get. So fuel is one of those things. In the handbook on page 41, if you've got that handy, the author separates, figures out how many hours of operation for his broccoli crop that is being used by a particular tractor and how much fuel that takes. And he's got a column for machinery costs, even though they might be down below $1 a piece. He's getting very detailed and allocating that fuel cost as a variable cost so that he knows in more depth whether his broccoli crop is making a profit or not. He allocates the utilities from the greenhouses and which crops that he starts in the greenhouse or raises there. And I recognize that I am getting close to running out of time. You can tell I am a talker. So let's move to the next slide. Okay, so some of the things that you need to know when you're doing these this planning and projections, go ahead and move to the next slide. We're going to talk about break-even analysis a little bit more when we talk about marketing. So there are only 3 ways to make more money in a small business. You need to sell more stuff by increasing volume, cut your costs or expenses, or raise your prices. And you can see that's in italics font because a lot of times we're not charging enough for our products and services. So let's go to the next slide. Now, previously, again, we've been talking about gross profit, and we're moving now into talking about calculating net profit. So we're not just talking about those variable or cost of goods sold expenses, we're talking about all expenses. So all sales minus all expenses equals our profit or loss. So let's move to the next slide. And again, I've already touched on this a little bit. We want to, and some of the questions have been about this, how we are allocating or calculating those fixed expenses when we're doing an enterprise budget analysis. And the examples in the book are excellent, but I just want to emphasize a couple of things here. Make sure if you are calculating whether or not this is going to make money, that by some way you are allocating all your fixed costs. So if you can do it directly when you know that 20% of your feed is going to your chicken operation and 80% is going to the other animals, you can know that exactly. You can allocate it when you put in your invoice. But fixed expenses are more difficult to allocate. So one method is by the acre. Another is by the enterprise percentage of sales. So we've got an example of that coming up. By the animal, when the question came up about the goats versus the sheep enterprise, okay, how many animals of each? Or how big are the animals? Maybe it takes 2 sheep to equal 1 goat, depending on the goats. And so you allocate it by that way. But you allocate it how it works for you. And then, or as Mr. Wiswald did, he used a combination of different methods. Let's go to the next slide. So when you're allocating all of your costs, don't forget taxes and depreciation and loan interest. You want to be including all your expenses, although technically loan payments are a move on the balance sheet and are not considered expenses. Yeah, let's get into the next slide because we're almost out of time. And this is a good one. So I have given an example here of two different ways to allocate the fixed expenses. So we have products A, B, and C. Those could be asparagus, broccoli, and carrots. We have a dollar sales figure. We have a cost of goods sold, and then we have a gross profit. And you can see, obviously, our gross profit in this example is highest with the carrots. Now, we're allocating fixed expenses, so we've got $5,000 worth of fixed expenses, and if we do that by percentage of sales, we can see that the asparagus is 16%, we've got about a third in the broccoli, and about 50% in the carrots. And we allocate that out, and that line didn't transfer over right, but the net profit down below, you can see, is lower for the broccoli than it is for the asparagus, and that's because those costs of goods sold were higher. But if we allocate by percentage of acres, I've put 1/3, 1/3, 1/3 here as the acreage, and we can see that in that alternative analysis, we're losing money on the asparagus, and in both ways we're making the most money on the carrots. But just that different way of allocating those fixed expenses could affect your decision. And so you need to, if a big part of your fixed expenses is rent, then it's by percentage of acres. If a big part of your fixed expenses is advertising, then maybe it's percentage of sales. Okay, so we're almost done here. Got a couple more slides, but they aren't all that important. But let's go to questions.
Okay, I think people are maybe a little overwhelmed. There have been no questions that have come in since the last question session, but let's go back and delve into some of the questions about inventory again. And this question from Amanda is, she says she bought 1,000 labels for ice cream pints. Does she have to count how many labels she used in 2013 and only count those as a cost for 2013? And then carry the ones left over to 2014? She said it seems extremely arduous.
Well, what I would recommend, if it's a significant expense, is a percentage. I used 1/3 of them, so I'm going to figure 1/3 of that as an expense, and the rest as an inventory carryover. If it's not a significant, if it's less than, 5% of your costs or something, just expense it. Or if it's less than $100. A lot of times, any kind of supply like that, if it's less than $100, you can just expense it. But if you're really wanting to know what it's costing you, then make sure that that carryover is considered in your analysis.